All right, we are continuing on with objective 1.4 from chapter 1. So, objective 1.4 is to evaluate business operations through the financial statement. So, first thing we have to think of are the financial statements. The four primary financial statements are the income statement, statement of retained earnings, balance sheet, and the statement of cash flows. And we'll do this, the statement of cash flows we're going to address later. We just mentioned it now for the sake of completeness. So the income statement presents revenues, expenses, and net income. So here's a very simple statement with just revenues, expenses, and net income or net loss. So that's when I say net income or net loss, you're either going to have net income or net loss here. Um, and if there is a loss, you'd put it in parentheses. When you're creating the financial statements, you want to create them in this order of income statement, statement of retained earnings, and then the balance sheet. And the reason is that net income is going to be used in the next financial statement, the statement of retained earnings. Um, Let me step back just a second. I do want to point out that these titles do have a certain format. The name of the company, the name of the financial statement. If it's a financial statement that measures flow over a certain period of time, then you will have a line that starts for year or for quarter ended, and then the date. So both the income statement and statement of retained earnings are measuring something that happened over a certain amount of time. So they will both have that 4 year ended, 4 year ended. Okay. So we have to put net income or net loss. Once again, if it's net income, you add it here, but you'll have one or the other. One or. You won't have both of those. And you will subtract, so it'll be less dividends always. So you'll start with the prior year's retained earnings. That number would be available from the prior year's balance sheet. You would typically have net income, you add net income, and then subtract dividends, and you'll end up with the retained earnings that will go to there. Okay? That's why you have to do it in that particular order. Now, the income statement we have here is overly simplified, but by and large, it will be revenues first, then expenses. What will happen, though, is there might be some subcategories. For example, interest is usually broken out, income taxes are usually broken out, and depending on the industry, certain other subtotals may be highlighted. Um, the statement of retained earnings, more or less that same format. The balance sheet, a couple things I'll point out here. Assets and liabilities will have current assets and current liabilities. Those assets are assets that could be converted to cash now or um, can will be paid off within the year or be paid in the year. Payment will be received. Liabilities are current liabilities are liabilities that are going expected to be collected in the year. PP&E, this is an account we're going to see a lot, property, plant, and equipment. So these will be things like trucks, buildings, things you expect to last longer than a year. You may or may not have a total long-term assets line, but you'll have total assets here. These two should be equal, so T, G equal T there. And this is why it's a balance sheet. Total assets equals total liabilities plus total stockholders' equity. It's your accounting equation. Total liabilities, you'll have your total stockholders' equity. Add those two together, you'll get this. And if total assets doesn't equal total liabilities plus total stockholders' equity, then something's wrong on the balance sheet. The balance sheet has to balance. Balance sheet must balance. Okay. So we really haven't done any evaluating yet. We're just introducing these statements. So here's a little very simple evaluation. Net income. This is more is better. All right. Now, does it get more complicated? Yes. But in general, all else equal, more is better. Net loss, bad. Almost always the case. Is there any possibility where it's better? Well, yeah, if you would have lost more, but you ended up not losing as much, sometimes that's good news. Um, so net loss is bad. Net income is okay, but more is better. Cash flows, we'll deal with this later, okay? So this is very important, but we're really trying to get just the financial statements in the first few chapters, the income statement, statement of retained earnings, and balance sheet in the first few chapters. So evaluating financial position, can you pay your near-term obligations? A thing called the current ratio. So it's current ratio equals current assets over current liabilities. You can think of it this way: if utilities, cell phone bill, car payment. Let's say you owe $800 in the next month, and you have $100 of cash in your checking account. Not the best position to be in. If you had 1,000 in your checking account, you'd be in pretty good shape. All right. So for corporations, um, they definitely want a current asset to current liabilities greater than one. Okay. Is the other thing to look at? So this is liquidity, which is more of a short-term view. Is the debt large? So you could take total liabilities to total assets. And what does it mean to have a large amount of debt? Well, it just means you're more financially risky. You can't go bankrupt if you don't have debt, both as an individual and as a corporation. Doesn't mean you can't lose money. It just means you can't have a debtor take you to bankruptcy court. So more liability, all else equal, makes you more financially risky. So this is financial risk. Okay. So if you ran an all equity company, you'd have no financial risk. Um, you could lose money, but you'd have no financial risk. So here we are in the first chapter, and you're already getting a sense of how you can use accounting information to assess performance. So net income is good, net loss is bad. More current assets are better. Um, debt can increase your risk. So sometimes though you get higher risk, higher return. So this is kind of uh, this is riskier. So financial risk is higher, but it may pay off more. So this one is a tough one to analyze, and we'll return to the more detail through the semester or through the term, and when we get to the end of the term, we look at financial analysis in particular. Okay, but all else equal, financial risk is up. Is this, I guess, the thing to say, is this good or bad? It's not clear yet. You need more information. Okay, but it is more risky. All right. So we'll move on in the next video to objective